Japan appears to have reached a breaking point. For many months, the Japanese yen has been depreciating, losing value against the dollar and causing import bills to surge. This devaluation has been significant. Before the Federal Reserve hiked rates, the yen was around 120 to the dollar. A week ago, it was well over 160 to the dollar. That's a staggering devaluation of at least 33%. Prices across Japan have skyrocketed, forcing people to cut back on spending. It's crucial to note that all previous currency interventions have effectively failed. Each time, the yen would strengthen briefly before collapsing again against the dollar. Given the state of Japan's economy, the government has no choice but to keep intervening. The country is slipping into economic stagnation. While cheaper exports can be beneficial, it's risky to ignore local consumption. If the yen becomes too weak, the country could collapse as people become increasingly impoverished. Japan risks being reduced to a manufacturing colony, essentially a sweatshop exporting goods to the world. Consumer spending fell by 1.8% in May, a significant deviation from the expected 0.1% growth. Why are people cutting back? Prices for food and other consumer goods are rising. Prime Minister Kishida is struggling in the polls and must find a way to reverse this disaster. However, Japan's problems are structural. They can't withstand higher interest rates without risking the collapse of their debt bubble. This leaves currency intervention as their primary strategy, involving endless selling of dollars to buy back the yen. It's clear that the recent significant drop in the yen was due to intervention by the Bank of Japan. The yellow line indicates a massive fall in the dollar against the yen on July 11th, following a similar pattern to interventions in April and May, when the BOJ spent $61 billion worth of reserves to defend the yen. The magnitude of the recent drop suggests this intervention also cost tens of billions of dollars. This effort seems almost futile, as Tokyo is fighting against the tide. As long as the Federal Reserve refuses to cut rates, the yen is likely to fall to 170 or even 180 against the dollar. Interestingly, the market expects this intervention to fail like the previous ones. Traders continue to bet heavily against the yen, with short positions still at levels seen during the 2007 to 2008 financial crisis. What's notable about this situation is how Japan chose to conceal its intervention. Kanda, the Bank of Japan's currency chief, continues to be evasive about their dollar sell-off. This may be because Treasury Secretary Yellen has previously warned Japan about currency interventions, emphasizing that they need to seek permission and communicate their actions, and that such interventions should not become routine. Japan likely timed their intervention around the U.S. CPI report because U.S. inflation fell in June, which would naturally help the yen strengthen a bit. However, it's glaringly obvious that Japan entered the markets to prop up the yen, as the currency moved more than 2% within hours or even minutes, an unnatural shift. The Bank of Japan has few options left as the economy teeters on the brink of another recession. They must protect the currency, even if it seems like a losing battle. Analysts are forecasting a GDP contraction of 0.4%, which is troubling when other G7 economies like the US and Germany are expected to grow this year. In a recovering global economy, Japan's numbers should be improving, not declining. The real winners in this scenario are the companies and individuals invested in Japanese stocks. A weak yen benefits them greatly. Take Honda, for example. Their profits grew by 70% last year due to the collapsing yen. Honda exports their cars globally in US dollars, and when they convert those earnings back to yen, their profits surge. This situation is great for Honda, but for the average Japanese salaryman, it's a different story. Salaries have increased by 30% over the past year, but this surge hasn't kept pace with inflation, resulting in a significant loss of buying power. The broader implications of this currency battle are crucial. Japan's demand for U.S. bonds will diminish over time, forcing Japan to repeatedly intervene to stabilize the yen. This means selling off their holdings, which could create a societal divide. Big business owners reap the profits while paying their workers in devalued currency. For tourists, this situation is different. Dining in Japan has become incredibly cheap if you're holding US dollars. For example, A sashimi dish at a Michelin-starred restaurant costs less than $5. However, for locals, prices have likely risen due to inflation. The Bank of Japan can't allow this to continue indefinitely. They will keep selling dollars to try to protect the yen, but this strategy won't work long term. The only lasting solution will come when the Federal Reserve significantly cuts interest rates. Speaking of inspiration, let's talk about the US and NATO. At the recent NATO summit, the alliance made a surprising statement. Their focus has shifted towards China. According to the NATO communique, the PRC has become a significant enabler of Russia's war against Ukraine through its no-limits partnership and substantial support for Russia's defense industry. It's clear that the West's attention is moving from Russia to China. The war in Ukraine is likely to continue for many more months, or even years, exacerbated by the West's production issues and financial problems. A scapegoat may be needed if the entire project falters. It seems the U.S. did not anticipate Russia's strong pivot towards China.
Our conversation with Zhuganov was repeated with Lebed. They talked about they don't want this NATO expansion, they know it's not in their security interests, and on, and said, well, and if you do that, we may have to look to China. And I couldn't help using the colloquial expression from my state by saying to Zhuganov, lots of luck in your senior year. Good luck. And if that doesn't work, try Iran. I'm serious. I said that to them, and these were that is not an option. And everybody knows, every one of those leaders acknowledges and needs, and they resent it. But they need to look west.
Biden certainly didn't anticipate this development. Russia has indeed joined forces with China, particularly in terms of their economy and bilateral trade. NATO's shift towards focusing on China is significant as it paves the way for various economic sanctions. Over the past few months, there have been several threats made in this context. Blinken has warned Chinese industries, and Janet Yellen has threatened sanctions on Chinese banks. Now, Biden has jumped on the bandwagon, going so far as to warn China about their trade relations with Russia. Biden aims to penalize Beijing by urging his EU allies to cut their investments in China. Essentially, he wants to starve Beijing of capital and prevent Western money from flowing in. This is a risky stance, and it's uncertain if his EU allies will agree with his approach. Biden is advocating for an economic war, effectively calling for an investment embargo on China. The reason for Biden's urgency is clear. While the West is preparing for China's economic collapse, the evidence suggests otherwise. China's trade surplus with the world continues to grow, reaching an astounding $99 billion in June alone. Despite the West's efforts to decouple from China, its exports are still increasing. Trade with Europe and the U.S. has declined, but overall, exports have risen. Beijing is earning more money than ever, with Southeast Asia and other regions like the Middle East buying more from China. As long as this trend continues, China remains effectively sanction-proof. Here's the trillion-dollar question: will Europe follow Washington's lead? It's uncertain, as the EU is becoming increasingly divided. Italy's Meloni is planning a trip to Beijing soon, and Germany fears Chinese retaliation over the EV tariffs. Additionally, Viktor Orban of Hungary, who recently visited President Xi, has made it clear that Hungary rejects NATO's stance against China, aiming to prevent the alliance from becoming an anti-China bloc. While there are pockets of resistance within the EU, let's assume for a moment that Europe does follow the Americans. It's possible, considering the blurred lines between foreign policy and economic policy under the U.S. security umbrella. The major concern should be China could retaliate, particularly in the EV and green investment sectors, which are crucial for Europe's economic survival and decarbonization efforts. Over the past 2 years, the majority of Chinese investments have gone to Hungary, which isn't surprising given their strong bilateral relationship. If EU countries pull back their investments, Hungary stands to gain significantly, potentially expanding its industries and catching up with France, Germany, and Italy. The EU is likely aware of this, and if they are smart, they will dismiss Biden's suggestions. Decoupling from China would be an economic disaster, especially if Beijing refuses to invest in EU countries. It's not just money that Chinese companies bring in when they invest. They also bring a wealth of expertise and technology that Europeans lack. A key question to ask is who truly benefits from this decoupling? If Europe pulls their money out of China, where else will they invest, especially industrial nations like Germany? The answer is likely the United States. Consider the actions of German companies in 2023. Giants like Volkswagen and Mercedes have poured billions of dollars into U.S. projects, creating thousands of jobs on U.S. soil due to lower energy costs. German companies have two main options for their investments. They can either go to their U.S. ally where energy is cheaper, or invest in China, which also offers cheap energy plus a superior supply chain. If Biden forces Europe to cancel investments in China, it will be a win for U.S. industries. This is a zero-sum game where the capital that China loses will flow into American companies. This underscores the strategic cunning behind the entire plan. Will Europe take the bait? We simply don't know, but it's undeniable that this economic war is escalating to new heights. It's no longer just about asset confiscation and sanctioning financial institutions. The U.S. is now trying to weaponize investment money itself. Will China take this lying down? Probably not. Many other markets are eager to work with Beijing, so they'll simply invest elsewhere. For example, Chinese EV giant BYD recently opened a plant in Thailand, bringing the country closer to its goal of becoming the Asian hub of EV production by 2030. This plant could export nearly 1 million electric cars, transforming Thailand's entire economy. What Europe loses, Asian countries will gain. The U.S. decoupling from China is practically a certainty, and this battle is only going to intensify. Europe might just end up as collateral damage. But what do you think? How long can Japan defend its currency, and will the EU stop investing in China? Let me know in the comments below. Stay safe, and be sure to smash the like button and subscribe as we navigate through these crazy times. Thank you for watching.